The clock is ticking on silver, and if you're not paying attention right now, you're about to miss something that only happens once every few decades. I'm talking about a convergence of forces so powerful, so unprecedented, that it's forcing some of the smartest money managers on the planet to completely rethink their positions on this metal. And here's what nobody's telling you. The window is closing faster than most people realize. Let me paint you a picture of what's happening right now in the silver market, because this isn't just another price spike we're looking at. This is a fundamental restructuring of how silver trades, how it's valued, and who controls it. And the people who understand what's coming are moving fast. Right now, silver is trading at levels that would have seemed impossible just a few years ago. We're seeing price action that's breaking decades-old patterns. But here's what's really interesting. While everyone's watching the price, the real story is happening in the physical market. The disconnect between paper silver and physical silver has never been wider. And that gap, it's about to snap shut in a way that's going to shock a lot of people. Think about this for a second. Every single solar panel requires silver. Every electric vehicle needs significantly more silver than a traditional car. Every 5G tower, every data center, every piece of modern technology we're building right now is consuming silver at rates we've never seen before. And here's the kicker. We're not mining enough to keep up. Not even close. The industrial demand story alone would be compelling enough. But that's just one piece of this puzzle. Let me tell you what's really keeping the big players up at night. Central banks around the world are diversifying away from dollar-denominated assets at a pace we haven't witnessed since the breakdown of Bretton Woods. They're not just buying gold anymore. They're looking at silver with fresh eyes, and for good reason. Before we go further, I want to make sure you're getting the full picture here. I've put together a comprehensive guide that breaks down the wealth protection strategies that thousands of American retirees are using right now to safeguard their savings. It's completely free, and you'll find the link in the description below. This guide covers things that most financial advisors won't tell you, and it might be the most important thing you read this year. Now, let's talk about what's happening in the supply chain, because this is where things get really interesting. Silver mining is not like flipping a switch. You can't just decide to produce more silver when the price goes up. The lead time on bringing a new mine online is measured in years, sometimes decades. And right now, we're seeing something that should terrify anyone who understands this market. Primary silver mines are becoming increasingly rare. Most silver today comes as a byproduct of other mining operations. Copper mines, zinc mines, lead mines. They produce silver on the side. But here's the problem. When those base metal prices drop, those mines slow down or shut down, and silver production drops with them. We're not in control of silver supply the way people think we are. The market is far more fragile than it appears on the surface. Let me give you a specific example of what I'm talking about. There's a major mining operation that was producing significant amounts of silver as a byproduct. When base metal prices softened, they adjusted their operations. Silver production from that single operation dropped by millions of ounces. Now multiply that across dozens of operations worldwide, and you start to see the problem. The supply side of this equation is not elastic. It doesn't respond quickly to price signals. Meanwhile, on the demand side, we're seeing something unprecedented. The solar industry alone is projected to consume more silver in the coming years than was consumed by all industrial applications combined just a decade ago. And that's just one sector. Electric vehicles are another massive demand driver. The average EV uses about twice as much silver as a traditional vehicle. And we're not talking about a gradual transition here. We're talking about a fundamental shift in how the world produces and consumes energy. But here's where it gets really interesting. The investment demand for silver has been relatively quiet compared to gold. Silver has been the forgotten metal for a lot of institutional investors. But that's changing. And when institutional money starts flowing into a market as small as silver, the price action can be explosive. Think about the size of the silver market compared to other asset classes. The entire above-ground silver supply available for investment is worth less than the market cap of many individual tech companies. It's a tiny market. And when you have industrial demand consuming more and more of the available supply, and then you add investment demand on top of that, you create a situation where price has to adjust dramatically to balance the market. Now let me tell you about something that most people don't understand about the silver market, the paper market versus the physical market. On the COMEX, massive amounts of silver trade every single day. But here's the thing, most of that silver doesn't exist. It's paper contracts, promises to deliver silver at some point in the future. And for years, this system has worked fine, because most people who buy these contracts never actually take delivery. They just trade the paper back and forth. But something's changing. More and more buyers are standing for delivery. They're saying, I don't want your paper promise. I want the actual metal. And when that happens, the whole system gets stressed because there's not enough physical silver to back all those paper contracts. Not even close. I want you to imagine what happens when this realization spreads. When more investors start demanding physical delivery instead of just trading paper, the price of physical silver starts to separate from the paper price. We're already seeing early signs of this. Premiums on physical silver coins and bars have been elevated for months. That's the market telling you something. There's more demand for physical metal than there is supply. Let me take you back to a moment in history that rhymes with what we're seeing today. In the late 70s, silver went on a run that shocked the world. It wasn't just about inflation, though that was part of it. It was about a fundamental supply-demand imbalance that the market had ignored for too long. When the price finally started moving, it moved fast, really fast. People who were positioned ahead of that move made fortunes. People who waited until it was obvious missed the opportunity entirely. We're seeing similar dynamics today, but with even more powerful forces at play. The industrial demand we're seeing now didn't exist back then. The geopolitical tensions driving central bank diversification are more intense than they were in the 70s. And the disconnect between paper and physical markets is wider than it's ever been. Here's something else that's not getting enough attention: the gold to silver ratio. Historically, this ratio has been a powerful indicator of relative value between the two metals. Right now, even with silver's recent strength, the ratio is still suggesting that silver is undervalued relative to gold. When this ratio normalizes, and it always does eventually, the move in silver can be dramatic. Think about what that means in practical terms. If you believe gold is going higher, and the historical relationship between gold and silver reasserts itself, then silver has to move even more dramatically than gold. It's not just about silver going up, it's about silver outperforming gold, potentially by a significant margin. Now, I want to talk about something that's critically important for anyone thinking about their financial future. We're living in a time of unprecedented monetary experimentation. Central banks have expanded their balance sheets to levels that would have been unthinkable a generation ago. The amount of currency in circulation has exploded, and while the official inflation numbers might not reflect it fully, anyone who's buying groceries or paying rent knows that the purchasing power of currency is eroding. This is where precious metals come into the picture as a wealth preservation tool. And for Americans with significant retirement savings, there's a strategy that's worth understanding. If you're sitting on $100,000 or more in retirement accounts, there's a way to get physical precious metals into those accounts without triggering tax penalties. I've put together a detailed guide on how gold IRAs work, and it's available in the description below. It covers the mechanics, the benefits, and the things you need to watch out for. This isn't about making a quick profit. This is about protecting wealth you've spent decades building. It's worth understanding your options, especially given everything we're seeing in the markets right now. Let me get back to what's happening in the silver market specifically, because there are some developments that are flying under the radar but could have massive implications. The LBMA, the London Bullion Market Association, has been the center of global precious metals trading for generations. But recently, we've seen some interesting shifts in how metal is flowing through that market. Inventories have been declining, not gradually, sharply. And when inventories decline in a market where demand is increasing, that's a setup for a price spike. Here's another piece of the puzzle that's fascinating: the behavior of commercial traders. These are the big players, the ones who actually produce or consume silver in their businesses. They hedge their exposure in the futures markets. And right now, their positioning is telling us something important. They're not as heavily short as they typically are. That's significant because commercial shorts have often been a ceiling on silver prices. When they step back, When they're not as aggressively positioned on the short side, it removes a major source of selling pressure from the market. At the same time, we're seeing increased interest from hedge funds and other speculative traders. But here's what's interesting. The speculative positioning isn't at extreme levels yet. We're not seeing the kind of frothy, everyone and their brother is buying silver sentiment that typically marks a top. We're seeing smart money accumulating positions, but we're not seeing the retail frenzy that comes at the end of a move. That suggests we're still relatively early in this cycle. Let me tell you about a conversation I had with someone who manages a significant precious metals fund. He told me something that stuck with me. He said, "The silver market is like a coiled spring right now. All the fundamental forces are pointing in one direction, but the price hasn't fully reflected that yet. When it does, when the market finally wakes up to what's happening, the move is going to be fast and violent." That's the word he used, violent. And when you look at silver's history, that's exactly how it moves. Silver doesn't grind higher slowly and steadily like some other assets. It sits quiet for long periods, and then it explodes. And the people who make money in silver are the ones who are positioned before the explosion happens, not the ones who chase it after it's already moving. Now let's talk about some of the geopolitical factors that are adding fuel to this fire. The de-dollarization trend is real, and it's accelerating. Countries around the world are looking for alternatives to holding their reserves in dollars. Gold has been the obvious beneficiary of this trend, but silver is starting to get attention too. Why? Because silver has industrial applications that gold doesn't. It's not just a store of value, it's a critical industrial metal. And in a world where supply chains and resource security are becoming geopolitical priorities, that matters. Think about what's happening with the BRICS nations. They're actively working to create alternative payment systems, alternative reserve currencies. They're talking about commodity-backed currencies. And when you talk about commodity backing, silver has to be part of that conversation. It's too important industrially to ignore. Here's another angle that's not getting enough attention: the environmental regulations that are impacting mining operations worldwide. It's becoming harder and more expensive to open new mines. Environmental reviews take longer. Community opposition is stronger. The regulatory burden is heavier. All of this means that even if silver prices go significantly higher, the supply response is going to be slow. We're not going to see a flood of new production come online quickly. The supply side is constrained in ways that it wasn't in previous cycles. And then there's the recycling question. People often point to recycling as a source of silver supply that can help balance the market. But here's the reality. Most silver that's used industrially is used in such small quantities, spread across so many products, that it's not economically viable to recover it. The silver in your phone, in your computer, in solar panels, most of that silver is effectively lost. It's not coming back into the market. So, recycling, while it provides some supply, is not the answer to the supply deficit we're facing. Let me paint you a scenario of what could happen if just a small percentage of institutional money decides to allocate to silver. Let's say pension funds, endowments, sovereign wealth funds decide to put even 1 or 2% of their assets into silver. We're talking about trillions of dollars in total assets. 1% of that is tens of billions of dollars. Now try to buy tens of billions of dollars worth of physical silver in a market where the total above-ground investment supply is measured in the low hundreds of billions. You can't do it without moving the price dramatically. This is why some analysts are talking about silver potentially reaching levels that sound crazy to people who are used to thinking about silver as a $5 or $10 or $20 metal. When you run the numbers on what happens if institutional allocation increases even modestly, the math gets really interesting really fast. But here's the thing. You don't need to believe in the most bullish scenarios to see value in silver right now. Even if you just believe that industrial demand continues to grow, that supply remains constrained, and that some portion of investment demand comes back to this market, you're looking at significantly higher prices from here. The risk-reward is compelling even with conservative assumptions. Now let me talk about timing, because that's what everyone wants to know. When is this going to happen? And the honest answer is nobody knows exactly. Markets don't move on a schedule, but what we can say is that the setup is in place. The fundamentals are aligned. The technical picture is improving. The sentiment is shifting. All the ingredients are there. What we're waiting for is the catalyst, the event or series of events that causes the market to reprice silver based on these new realities. That catalyst could be a supply disruption at a major mine. It could be a large institutional buyer entering the market. It could be a currency crisis that drives safe haven demand. It could be a short squeeze in the paper market. Or it could be something we're not even thinking about right now. But when it comes, and it will come, the people who are already positioned are going to be glad they didn't wait. Here's what I want you to understand. The silver market is not efficient right now. There's a disconnect between the fundamental reality and the price. And when markets are inefficient, when there's a gap between reality and price, that gap eventually closes. It has to. The question is not if, but when. And the people who recognize these inefficiencies early are the ones who profit from them. Think about every major market move you've seen in your lifetime. The people who made life-changing money weren't the ones who waited until it was obvious. They were the ones who saw the setup developing and positioned themselves ahead of the crowd. They were the ones who were willing to look at the evidence, think independently, and act while others were still skeptical. That's where we are with silver right now. The evidence is mounting, the fundamentals are clear. But the crowd hasn't caught on yet. The mainstream financial media is still largely ignoring this story. And that's exactly when the opportunity is greatest. Let me tell you about one more thing that's happening that I find really interesting: the behavior of silver miners. These companies, the ones that actually dig silver out of the ground, they're not expanding production aggressively even though prices have been rising. Why? Because they've been burned before. They've seen silver spike and then crash. They've learned to be cautious. But what that means is that even as demand grows, supply is not responding the way economic theory says it should, and that creates an even tighter market going forward. The mining companies are also facing their own challenges. Labor costs are up, energy costs are up, equipment costs are up. The ore grades at many mines are declining, meaning they have to process more rock to get the same amount of silver. All of this means that the cost of production is rising, and that puts a floor under silver prices. Miners can't produce at a loss indefinitely. At some point, if prices don't rise to meet their costs, they shut down. And that reduces supply further, which pushes prices higher. It's a self-reinforcing cycle. Now, I want to bring this back to what it means for you personally. If you're someone who's worked hard, saved diligently, built up a nest egg for retirement, you need to be thinking about how to protect that wealth in an environment where currency is being debased, where inflation is eroding purchasing power, where traditional safe havens like bonds are offering negative real returns. Precious metals have been a store of value for thousands of years. They've survived every currency crisis, every financial panic, every economic upheaval, and they're going to survive whatever comes next. The question is not whether you should have some exposure to precious metals. The question is, how much and in what form? And for those of you who've been watching this video all the way to the end, I want to make sure you know about something special. If you're an American retiree with at least $100,000 in any retirement account, and you request the free guide in the description below, you'll also get access to an exclusive one-on-one educational web conference. No obligation, no pressure, just education. This is only available to people who mention they watched this video, and it's a chance to get your specific questions answered by someone who understands this market inside and out. Here's the bottom line. Silver stackers are on the clock. The window of opportunity to position yourself ahead of this move is open right now, but it's not going to stay open forever. Once the crowd figures out what's happening, once the mainstream catches on, the easy money will have already been made. The people who profit the most from major market moves are always the ones who act while others are still debating whether to act. The fundamentals have never been more compelling. The supply-demand imbalance is real, and it's growing. The industrial demand is accelerating. The investment demand is starting to wake up. The paper market is showing cracks. The geopolitical environment is supportive. The monetary backdrop is favorable. Every single factor you'd want to see is pointing in the same direction. This is not about speculation. This is not about trying to get rich quick. This is about recognizing a fundamental shift in a market that most people are ignoring and positioning yourself accordingly. It's about understanding that we're at a unique moment in time where multiple powerful forces are converging on a small market, and that convergence is going to drive prices significantly higher. The clock is ticking. The countdown is on. And the people who understand what's happening are moving now, not waiting for confirmation, not waiting for the mainstream to validate their thesis, not waiting until it's obvious to everyone, because by the time it's obvious to everyone, the opportunity will have passed. So ask yourself, are you going to be someone who looks back on this moment and wishes you'd acted? Or are you going to be someone who recognized the opportunity, did your homework, and positioned yourself ahead of the move? The choice is yours, but the window is closing. The silver market is about to reprice in a major way, and the people who are ready for it are going to be very glad they didn't wait.